Hi, real estate enthusiast. So I am hopping in. I've talked about joint ventures, JVs in the past, and I've had a couple of questions come up on kind of how you do those splits with the investors and kind of how you look at the deals and what is kind of maybe industry standard on what you would be splitting, per an equity investor or an operations investor and kind of what that would look like. So I'm just going to run over a few just generalized numbers, but I do want to kind of get into a little bit more than just kind of what the industry standard may or may not be, because as you guys should be aware, there really isn't an industry standard, at least there shouldn't be. So there isn't something that the industry can just always do, but there's something that investors tend to, like passive investors and stuff like that, tend to start to expect. So that is kind of where industry standard comes in play, because passive investors are used to certain type of returns based on specific asset classes. So for example, multifamily varies. So if you are new in multifamily, oh, sorry about the glare, that light's on over there, but if you guys are new into multifamily, so you are new to a syndication or it's maybe a smaller deal and it's your first multifamily deal, it's your first commercial deal, something of that nature, you tend to give away more of the deal to your passive investors to kind of help mitigate the risk because you're not an experienced investor in that asset class. So for starters, I've seen up to 90-10% split. So what that means is 90% actually goes to your limited partners, your passive investors, and 10% goes to the operators. There's lots and lots of different words for the 10% people in the multifamily deal. So it's been a while since you've seen splits that favorable to limited partners. But like I said, I've seen it for new, like if you're just coming into the market and you have some experience, maybe in single family, but you've just never done multifamily before. I've seen up to this range of them giving away that much of the deal just to pull in and entice limited partners and passive investors. So this is great and dandy for maybe like a first deal, just so you can get that on your portfolio. And that's pretty much the point, because hopefully if you have any limited partners, they're not expecting this number, because you cannot have this number across your portfolio to actually make it make sense to be operating and overseeing multiple multifamilies if you're only getting 10% of the deal moving forward. So a very, very common split is you'll see the 70-30 or 80-20. Both of these are very, very common in multifamily. This you start to see along the lines, maybe if it's like a heavier business plan to actually like renovate and rehabilitate a project. You might see this split because there's definitely going to be a lot more work and hands-on for the syndication team, or they're highly experienced, and so the investors coming in, they're willing to take a little bit less because the risk isn't there anymore, because they're a team that has a very large portfolio. When things go bad, the passive investors know that that team can actually maybe fund a deal or float a deal or something like that, and usually their numbers are very strong because they've done it so many times that there's little to no surprise after takeover, because they're so experienced that they kind of know what to expect, maybe for rehab or rent turnaround or stabilization. There's less surprise on the operational side because they've done so many. So there will be LPs that are open to taking 70% of the deal. Again, this is the passive investor side, the larger number. Limited partners are willing to take a little bit less because the team has their own portfolio, they have their own liquidity. It's just a deal large enough that they need to actually pull in other investors, or they're smart investors and they realize it makes more sense to use other people's money. So I have seen this 80-20 is definitely a more common number. And again, I'm speaking about multifamily primarily. So this is the trick that comes into play. So if you are dealing with a multifamily investor who is used to these types of splits, and you go into single family and you are going to be doing a rehab flip or, the BRRRR strategy or some buy and hold or something like that, that you're going to be doing single family, these numbers don't really make sense for you anymore. You can do these splits still, but most of the time, single family, you're dealing with, you might be capitalizing on $20,000 that for each individual, like maybe for a 50-50 split. Single family can get fairly large, but 20% of $50,000, you're kind of giving away a huge chunk of the property, and single family takes as much work as a larger deal would. You're still doing operations, paying bills, overseeing contractors, running the market, doing acquisitions. You're still doing everything. It's just like on a smaller scale, which means that split is going to be astronomically smaller. So for single family, a lot of the times you'll see a 50-50 split. I have seen the number more in favor of the active investor. So I have seen this number less. In addition to, a lot of them you do just interest only. They're set up more as kind of a second lien or a private loan where they get a certain interest rate every single month. They kind of get their money, or they're gonna make a certain interest off the property, and then they might actually do an equity split dependent on how big that gap is. So this, you can definitely get creative on this, but in my experience, these splits don't align with single family properties. So again, when you're looking at other commercial deals, so if you're looking at RV parks, storage facilities, a lot of times I work with investors who they're more interested in making a certain interest every year on their money. They want a kind of more of a guarantee. And so they're looking at an interest rate. So they're willing to either be like a second lien or something like that based on getting an actual interest rate. They might be doing a certain amount of profit share every month. But again, my numbers are more along the lines of a single family deal, not a multifamily deal. So I bring this up. So these are just kind of generalized opportunities, because I'm going to kind of quickly talk about kind of why passive investors would do a deal and why it's so important to kind of ask specific questions, because I feel that people invest in real estate based on their personality, their emotion. They're personally connected to a deal for a specific emotional reason. And so many people, they look at real estate, all numbers. And they're like, nope, I'm looking at it as a number. Well, your numbers, you're emotionally connected to the numbers that you choose to be getting back and having a return, because some investors in multifamily, they'll only invest in deals that are 90-10. Some investors won't ever invest in that because that means that there's a higher risk for the operational team, and they'll only invest in 70-30. Okay, well now each investor says, I am investing based on my numbers and my numbers only, when the actual decision isn't actually based on the numbers. It's based on their emotion connected to the numbers, because it's what they're willing to risk and why they're investing and what they need that investment for. So when you are going into a joint venture with an investor, and it doesn't have to just be your financial equity partner or financial investor, anything like that. I think it's a really good idea that when you are working with investors and you're aligning yourself with someone, to ask them why. What is their purpose when they're investing in real estate? Because some people have such a large W-2 that they need to offset it with depreciation. Well, if that's the case, these numbers, you're sitting there trying to negotiate and hone in on these numbers when they make so much money every year that this matters to them. but they care more about actually capturing the most of the depreciation of the property. And you won't know that unless you actually kind of get to the root of what they're connected to emotionally, to the numbers that they're looking at. So when I go into a joint venture, I actually like to talk to my investors. What is their purpose? Like, what is their plan? Like, why do they invest in real estate? How long do they plan on investing in real estate? How long do they like to have their money out? How comfortable do they feel with certain numbers and certain returns? And so I kind of gauge an idea of where I actually can be negotiating and what they actually care about. And so then I know, okay, well, if I am buying a property just because I need depreciation, and I'm talking to an investor who they only need the depreciation, that's not actually going to align for us. It doesn't matter if I give them 90% of the deal. They're going to be like, I don't need more of the deal. I need the depreciation. If I actually show more income, that's going to hurt me, this calendar year. And so we might be arguing and negotiating numbers that just don't make sense for anybody. So I wanted to bring this up. For me, it's highly important is to find the emotional connection of your partner in your joint venture, then base it off. Then you can actually delve into which numbers align the most. And then you got to see if that makes sense for the deal. So if you're working on a huge flip in multifamily and it is just going to take you 12 to 18 months to actually create your CapEx and turn over all the units and start seeing your pro forma, and they're highly connected to a 90-10, and maybe you are an experienced investor, then I would go look for another investor because that's going to take so much of your time. If it's kind of a class A, it's a takeover, it's stabilized, there isn't a huge shift in the business plan, and it's going to be an easy operational position for you, you'd probably be okay with 90-10 because it's taking little to none of your time. It was more of the acquisitions and then something that you just will have to oversee and manage maybe every quarter or biannually to make sure that everything is still in line, but it isn't something that's going to take up a huge chunk of your time. So definitely look at the emotional connection your joint venture has to the numbers that they are reaching out to you. And then look at the type of deal that you have to see if that can actually be something that you can provide to your joint venture partner. So again, I hope this helps. Joint ventures are super powerful because you can negotiate and because you can choose your partners. That is where the power comes in. And so make sure you're asking the right questions and you're providing them with what they truly are looking for and needing for their portfolio. So please comment below. I love to chat further about it, and stay tuned for my next video. Thanks.